Well, we think markets are inefficient over the long term, and there's plenty of evidence we see to support that. And therefore, we think that's our opportunity. So if we're patient as investors, we can exploit that opportunity. But if we want to do that, we really need to know what is driving share prices over that long term. And when we look at the evidence and decompose returns over different time periods, very clear to us it's the compounding of fundamentals that's driving the majority of your share price returns over the long term. That's earnings and cash flows and dividends. The opposite is true in the short term. Valuation, much more important in the short term, and that makes perfect sense to us because markets are noisy in the short term, and more importantly, those fundamental value markers of cash flows and earnings and dividends haven't had a chance to compound up yet. So the key for long-term investors is the fundamentals. So we set ourselves a dual mandate. The first part is to deliver superior capital appreciation over the long term, and the second aspect is for lower risk of capital loss, again through a full investment cycle of 5 to 7 years. And given our philosophy that we believe the fundamentals will drive the majority of that return, we therefore need to find companies that can compound up their fundamentals at a superior rate, but in a much more stable fashion. And we call these companies exceptional companies. And exceptional companies have a couple of really key characteristics. The first is to be able to create a really high economic surplus year in, year out consistently, backed by a strong competitive advantage. But that's not enough. They have to then be able to take that high economic surplus and expand it at above average rates for a very long time into the future, backed by strong capital allocation and supported by structural growth trends. That's what's an exceptional company for us, and that's what unlocks the magic of compounding. So again, because we set ourselves this dual mandate, we think it's incumbent upon us only to buy companies that are wholly appropriate to meeting both of those financial objectives. And therefore, when we're looking to construct our portfolios, we're not thinking about a benchmark. Risk for us means something very different to how we might be positioned against that benchmark. And we tend to think about risk in a couple of ways. The first thing we think about with risk is principally the type of companies we own. That is companies that can deliver that compounding machine, but in a much more stable fashion. That's our first line of defense. The second aspect of risk for us is, can we put our companies together so that we can diversify our long-term sources of cash flows? And we think it's much more important to try to find or try to understand where our companies are actually earning their cash flows from, by end market, by geography, by type of company, rather than the more traditional lens of just simply looking at where a company might be domiciled or what GIC sector it might be in. Much more relevant, and it gives us much more insight as to where our risk exposures actually are.